The Fed15 podcast is presented by Serving Those Who Serve, a financial planning practice serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of either Raymond James or Serving Those Who Serve. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. Welcome, everyone, to this week's episode of the Fed15 podcast presented by Serving Those Who Serve. Each week, we'll discuss the latest news and info that Feds need to know in 15 minutes or less, sometimes a little more, often a little more. So whether you are a seasoned federal employee or you're just starting out in your career, Fed15 has got you covered. So grab your coffee, kick back, and we'll tell you what you need to know but might have missed in the federal space this week. I am your host, Katelyn Murray, and I'm joined by my fantastic co-host, Mr. Dan Sipe.
Hey, Katelyn, how are you?
Doing well, man. You know, we're in the dog days of summer now, I think, technically. So, you know, just trying to ride out the rest of the warm weather season. We're headed for my favorite season, fall, but she is so brief and fleeting, it seems like these days. Fall and winter are like 2 weeks. So I'm soaking up the rest of the sun, and then it'll be, you know, a quick stop at the pumpkin patch before the long dark winter.
Well, you know, I don't want to rush too much, Katelyn, because as you know, at least for the Sipe clan, July, August is track season.
Mm-hmm.
Now, track technically kind of runs through the whole year, but right now, as we speak in Eugene, Oregon, at the University of Oregon, Tracktown, USA,
mm-hmm.
the USATF Nationals are going on, but also the USATF Paralympic Nationals. So for making Para Worlds, those of you who regularly follow know my children are active now in coaching. They completed their competitive careers, and I'm very proud of my son. He is working with an exceptional para athlete who made the games last year. And I am happy to say that yesterday she qualified for the world team in shot put through 102% of the A standard, because what you have to do is you have to finish in the top three for sure, but then you also have to throw beyond a certain distance to be able to be named to the team to go. So she was at almost 103% of that distance, and her best event comes up on Saturday, which is discus, where she hopefully will make a run at the American record. So holding out good thoughts for my son Colin, his athlete Samantha. It's a very exciting time for Clan Sipe with this stuff. And folks, if you ever have the opportunity to get to Eugene, Oregon to see Hayward Field, we were fortunate to be able to get out there in 2016 with one of our dear friends who's an Olympian to be there for the trials. If you like track and field at all, this is where track heaven is. You know, so if you're in track and you live a good life, this is where you end up going. So very, very exciting. And, you know, track and field is very dear to me. And I need to gin up a little bit of hate mail here. It is the one true sport. Okay, folks, just putting that out there. There are sports and there are games. If you put play with it, it's a game. And those of us who are in sports appreciate that. And our sports generally go into what makes up other games. So, you can start typing away and vilifying me. But just please subscribe when you do. Then you can hate me every single week.
Right. You don't want to miss an opportunity to leave feedback. Love it. All right. Well, other than hot takes on track, there are some very interesting things happening in the federal community. Also, really honestly, for financial planning at large. Obviously, recently we have the passage of the One Big Beautiful Bill Act, or OBBBA for short, which is very hard to say fast in meetings, can confirm, signed into law just earlier this summer. So this episode is going to be pretty heavy on OBBBA provisions and how that impacts overall taxes. Dan's going to kind of give us a rundown of some important changes, updates there. And then a little bit later, I'm going to get into how this impacts a very important planning strategy that we talk about a lot with our clients.
One of your favorites.
And one of my favorites, Roth conversions. So we're going to get into what OBBBA means for Roth conversions. But Dan, help us get a little bit more familiar with the tax provisions that are part of this piece of legislation.
Absolutely. Well, first thing, I'll always call myself out when I learn something that I probably should have known already. Bills get nicknames in this town. Okay, so the Affordable Care Act has a nickname. What is it called, Katelyn?
The Affordable Care Act?
Yes.
It's called a lot of things, Dan.
But what's your favorite? Obamacare.
Yes.
So Bill's,
I'm like, that's a dicey question for a podcast.
but it'll definitely get eyeballs.
Fair.
Now bills get nicknames. They just do, and I will call myself out as a dope that I Googled this morning. What is the real name of the one big beautiful bill?
Yeah.
And what I learned is that you just add the word act.
Yeah. Yes.
That's the actual real name. And so I'm just putting that out there, not making any comment on that. It just surprised me. I thought there would be a name that had like 37 words in it.
Yeah.
Because that's usually what we see. So it is indeed the One Big Beautiful Bill Act signed into law on July 4th. So there's a ton in this article, folks, and I'm not going to eat up the whole podcast with all of them. So I'm going to hit the high points and the ones that I think are most germane to feds. There are other ones that may apply to you. So for starters, standard deductions increased to $15,750 for single filers and $31,500 for married filing jointly, with a little asterisk with that because we'll be talking about SALT in a minute. So the seesaw between those two is pretty interesting. There's also a senior bonus deduction. So taxpayers 65 plus get an additional $6,000 deduction. That does phase out above certain income levels, $75,000 for singles and $150,000 for married filing jointly. Child tax credit is $2,200 per qualifying child, refundable portion of up to $1,700. SALT deduction cap. Okay, this was one of the big hot topics out of the act from 2016, where it capped state and local tax deductions at $10,000. That was increased to $40,000. It is indexed for inflation. It does phase out at $500,000 in income, and it will sunset in 2030. So that's the other thing that we're used to. We're in DC. So sunset, we understand. Sunset is how the legislators build in tax increases that nobody ever has to vote for. Yeah. All they have to do is stand and argue, and it goes through. A couple of interesting things. This is going back to OG's youth. There is a deduction for car loan interest. Katelyn, would you believe at one point in time, almost all consumer interest was deductible, including credit card interest?
So wild, but I could see that because if we look at also what interest rates were at that time, there was a whole lot more interest being paid as well. I mean, we think we're paying high interest now at 6 or 7% for a 30-year mortgage. It's nothing on the double-digit interest that we were seeing back in that time. Sure would be great if credit card interests were deductible now.
Well, it was. It was. And by the way, credit card interest was high back then too.
Yeah. Oh, yeah. No, I'm sure.
And so, but up to $10,000 of interest on new U.S. assembled autos. So loans for that. It phases out above 100,000 single, 200,000 married filing jointly. There's a list for figuring out if your car qualifies. So there's a lot that goes into this. I'm not sure this applies to a lot of our feds, but they may have a side gig. Deductions against tip income. So you can deduct up to $25,000 of qualified tip income. And it's available to folks earning less than 150,000 single, 300,000 married filing jointly. There is a break on overtime pay deduction. Be sure to go to the article for that one to dig into it more. Estate and retirement planning. So the estate and gift tax exemption has been made permanent. things are permanent until they're changed. Okay, let's be realistic about that. So that's $15 million per individual and up to $30 million per couple that can be passed along. There's something new called a Trump account for children born between 2025 and 2028. Check that out. It's an opportunity to do some additional savings. For your kids, there are caps and rules about student loans going forward. I'm not going to eat up a lot of the podcast going through all of them. You definitely want to get to the article so that you are familiar with that. And that includes grad loans. Clean energy tax credits are being changed pretty dramatically. So if you have these plans, get to the article, read them, understand what your deadlines are going to be. And then there's some pretty interesting things like there's a private school scholarship credit. So if you're making donations to nonprofits that are funding K through 12 scholarships, that might be something that helps you. And if you have side hustles out there, get to the article because there are advantages for small business for pass-through deductions. There are, and I don't think this will apply to a lot of our feds, they added work requirements for Medicaid. So a lot of stuff there. Get to the article. I tried to do high level, hit the stuff that would most likely impact our feds. But Katelyn, you're absolutely correct. There are some new rules and guidelines, to speak from Pirates of the Caribbean, revolving around Roth conversions. And I know that is one of your favorite topics. So tell us what's going on there.
Absolutely. Yeah. Roth conversions and HSAs, folks. It's just all that runs through my mind every moment of every day.
The financial lady loves that stuff.
So with the passage of this new piece of legislation, obviously we need to re-examine Roth conversions. Now, folks who have been longtime listeners of the podcast or folks who read our blog routinely will know that I actually did an article, a very in-depth article on Roth conversions last year, talking about this time crunch that we had under the current tax legislation at that time, which was called TCJA, the Tax Cuts and Jobs Act of 2017. So that piece of legislation was pivotal because it introduced historically low federal tax brackets. And originally, those tax brackets were set to expire at the end of this year, December 31st of 2025. So when that piece of legislation was passed and we had that lowering of those tax brackets, it created a great opportunity for folks to assess their Roth conversion, opportunities. And there was always that kind of date that the carriage was going to turn into a pumpkin, right? 12/31/2025. And so at that time, with that time crunch, knowing that those tax rates were going to sunset back to what they were earlier, which is much higher, there was a sense of urgency around Roth conversions leading up to 2025. So bringing you up to kind of where we are now, because that backstory is important. On July 4th of this year, with the passage of this new piece of legislation, those TCJA tax brackets became quote unquote permanent. And like Dan said, it's permanent only until the next guy passes a new piece of legislation and then we get new tax brackets. So currently our tax brackets, these historically low tax brackets, are indefinite. The effect that has on the Roth conversion opportunity is essentially just widening that time frame that Roth conversions could very, very much be worth it for many of our feds. So I'm not going to run through the tax brackets. If you want a refresher as to what they are now, you can hit our blog, hit this article. I've got a lovely little chart right there that takes care of both the single folks and the married filing jointly folks. But essentially, what we're looking at here is a wider window potentially for many folks to do Roth conversions. And now you might be listening to this podcast thinking, Katelyn, what is a Roth conversion?
What is a Roth conversion, Katelyn?
It's a fair question, Dan. So taking it back to basics a bit, a Roth conversion essentially involves taking a distribution from a traditional IRA. So we're talking pre-tax, traditional equals pre-tax, pulling that money out, paying income tax on the amount of the distribution in the current year, and then converting it over into a Roth IRA. Roth equals after tax or tax-free in some senses. Now, once you've paid, so it's all about when we send the money through the income tax loop. So if we pull money out of a traditional IRA, pay taxes on the amount that we pulled out, and then we plop it into a Roth and it sits in the Roth and grows for 20 years. all the growth is tax-free on that Roth, and you've already paid your taxes on the principal that you put into the Roth. So when used correctly, you never pay taxes on that bucket of money again, even though it's growing and ideally becoming more money, right? So the value of a Roth conversion is saying, hey, we've got these historically low tax rates right now, and we don't know how long we're going to have them, but we have them right now. So I'm going to choose to pull some sum of money out of my traditional pre-tax accounts. I'm going to pay the taxes at these historically low tax rates, and I'm going to plop them over into a Roth. And then I'm going to let that Roth grow. And then later, I'm going to pull that money out of the Roth once it's grown, when I no longer have to pay any taxes on it, ideally in a higher tax environment. And you say, but Katelyn, you just said that we have historically low tax rates that have just been made permanent. Remember, permanent is only permanent until we have a new piece of tax legislation. And our national debt, I will remind you, is $36.6 trillion currently. Okay? Think about it. With a $36.6 trillion national debt, what do you think the odds are that we're going to keep getting to pay historically low taxes when we have historically high debt?
If you're asking me, I'd say it is a relatively low likelihood.
Exactly. So, and we know that just like administrations, just like so many different things, it's kind of like a pendulum, right? Tax rates are kind of like a pendulum. We swing really far in this direction, which is the low direction. That's where we're at right now. We will swing back. And oftentimes, if you look at it historically, oftentimes it's with a fury. We swing back like it's intense. So,
and folks, don't forget, as recently, and that's going to sound strange because it goes back, nearly 50 years. But as recently as the 80s, the highest marginal bracket in the United States was 90%. Mm-hmm. 90%. That happens.
Yeah.
And so I think it's hard to argue that staying at the low end stays forever, because again, I was working in this business when the Reagan tax revolt took place, and tax brackets were flattened down to 15 and 28%. And it feels like they were there for a week.
Yeah.
So Great point, Katelyn.
Yeah. No, that's helpful, Dan. Yeah. I think it's good. It's good perspective, to view things. So about this point, you're probably thinking, well, Katelyn is telling me, the financial lady on the Fed15 podcast is telling me that I need to convert everything that I own over to Roth. No.
That's what I heard.
No, she's not. Roth conversions are a good idea for some. It is definitely worth looking into and seeing if it's a strategy that could work for you. But the goal here is not Roth is better than traditional. You'll never hear me say it, because we believe in tax diversification. Have some traditional, have some Roth, have some brokerage money that's not retirement money, that's taxed at capital gains tax rates, because those are flat 15%. So that's advantageous as well, even in these historically low tax bracket times. The 15% capital gains tax is still advantageous for many, many of our clients. So definitely look into it to see if it's a strategy that could work for you. As far as the mechanics of how it actually works and what the strategy is, you want to look at filling out lower tax brackets. So if you're in the 22% or the 24% tax bracket, look at what the top of that bracket is, figure out what your taxable income is, and figure out what your gap is. And I'm saying do all of these things, but ideally you want a financial planner and a CPA working together to make this happen for you, because this is a complex tax strategy, tax and financial planning strategy. And you really need to make sure that all those pieces fit together. So definitely hit the blog if you're curious about the benefits of Roth conversions. Just really quickly, RMDs are still a thing, required minimum distributions at age 73 or age 75, depending on when you were born. There are estate planning advantages. If you think about, we've talked about this on the podcast before, if you think about the age that your kids normally are when you are getting older and passing away, they're probably in their highest income earning years. So inheriting tax-free Roth money versus taxable traditional IRA money definitely can be advantageous depending on, what field your kids go into and what their socioeconomic status is looking like. So there's a lot more information in the actual article than what we can cover on a 15-ish minute podcast. And I'm already really bumping up against the time. So please do go to the blog and read this article in full. I think it's got a lot of food for thought in there. High level takeaways, Roth conversions could be a very meaningful strategy for a lot of feds for longer than we originally thought under TCJA. And number two, you really need professionals to help you assess whether this is a strategy that works for you and to help you execute this properly. So always consider consulting with qualified Fed-focused financial advisors and tax professionals. We love our CPAs when you are thinking about strategies like this one.
Indeed.
And please be careful. TSP said they're going to do in-plan conversions starting in 2026. We haven't heard anything. They have been totally going ghost, but TSP is kind of notoriously bad at reporting. Be careful with those in-plan conversions in the TSP. Please talk to a professional before you do that on your own.
Well, our buddy Ed Zerndorfer, he and I were talking yesterday, and as he has said, he has got his pencil already sharpened for all the things you're going to need to consider and what you're going to need to do with that. So, come back here, folks. Come back here. This is where you can find the information. No place like this. Okay, sort of one-stop shopping for all of it. And that's all the time we have for today. But folks, we'll be back next week to bring you the latest updates you need to know, make informed decisions about your career and financial well-being as a Fed.
And be sure that you are here for it. Analytics shows us that about 78% of folks who are watching our videos are not subscribed. So please do subscribe to the podcast on our YouTube channel or on Spotify if you're listening over there so that you never miss an episode. And please do remember to share it with your friends and colleagues.
Yep. And for more information about these topics and way more, check out our blogs at blog.stwserve.com or just go through the website. You can see the drop down and make it easy for yourself. Subscribe to our newsletter, The Weekly Serving, and we'll get the latest stuff shipped out to you. You don't even have to go looking for it every single week.
And for those who want to dive even deeper into learning about your federal benefits and financial planning for feds, we encourage you to join us for one of our complimentary webinars. We've got some great ones coming up this month. On August 20th, Jen Meyer from the team will be hosting the TSP planning webinar from 11 a.m. to 2 p.m. Eastern. And the very next day, on August 21st, Dan himself will be hosting the financial planning webinar, Financial Planning for Feds, 1 p.m. to 4 p.m. on that day. And we've got a whole host of other options that we don't have time to mention here. So hit the website and find exactly, the session that you need to learn about the piece of your benefits that you want to know more about. Do you want to know more about FERS, FEGLI, all that? We've got it for you. FEHB, that's a fun one too. Of course, if you prefer a one-on-one approach as opposed to the group learning environment, please feel free to reach out to our team directly for a financial planning consultation at meetings@stwserve.com. We would be happy to talk with you.
Absolutely. So, Katelyn, as much fun as it's been, we got to wrap this one up. So, folks, thank you for listening to Fed15. I'm Dan Sipe.
And I'm Katelyn Murray.
And we will see you next week.